First person is A, second person is B. Both of them are traders. How much of BTC can I enter for my margin positions? So that losing whole wallet, this case is not happening one, because since that we place a cut loss there. Wallet management means that how you deal with the percentage. Let's say I only have $1,000. If I place 1%, my liquidation price is also very far away. But if you're using like 100k, 1% is 1,000. It's still the same thing. It's just about percentage. There's two person. First person is A, second person is B. Both of them are traders. The A one have the trading performance consistent one. 5% at the first year, second year 5%, third year 5%. At the B side, 50% at the first year. Second year, 50% also. But at the third year, you have a 50% loss. A or B, who you will invest? Now we just try to calculate. Let's say I have $1,000 invested in. What is the better reward that we are getting? 1,000. After 1 year, 5% growth, 1,050. Another year, 1,102. Third year, 1,157. Okay, divided by 1,000 is 15.76% growth. Now for B, 1,000, okay, it becomes 1,500. Again, another 50%, 2,250. But at the second year, it drop performance, it becomes 1,125. So 1,125 divided by 1,000 is only 12%. You seeing that like wow, B trader like very king like that, or wow, 50%. But as you can see in the long run, right, even though I just earning 1 year 5%, I also can win over the 50% win. Okay, so that this is the important concept, also the mindset that you have in. Always try to not lose. Of course, we cannot prevent, but we need to minimize it, because the factor that is deciding that you can win lot or win little is on the market. It's not on you. Okay, even though how bad you want to earn the 50%, if the market say no, you cannot earn. So for this sharing, I'm not talking about you don't want to aim for this kind of percentage, 50% or 100%. Of course you can aim, but steady profit is way more powerful than those kind of big fluctuations one. Cross versus isolated. Okay, we give three kind of scenario. There's 10 times leverage, cross leverage, and 100 leverage. Now here is the scenario. If I want to enter the positions that is 10,000, three of these cases I want to enter $10,000 worth of contracts. Yeah. So what is my costing? Okay, because you can see every scenario is the same on the position contracts. Value amount is 10,000. But who can answer me if I'm using 10 times leverage? What is my costing to place a 10,000 contracts based on the 10 times leverage? Who can answer me? 1,000, that's correct. 10 is equal to 10,000, because this is the function of using the leverage, because you want to have a lower costing to enter bigger positions. So this is why there's the existing of leverage trading. Okay, we just skip the cross first. We use the 100 times first. If I'm using 100 times leverage, how much is my costing? 100. Okay, very easy, because 100 times 100 is equal to 10,000. For cross, still remembers I say that cross is actually like 100 times leverage. So if this is the case, my costing on cross, if facing a $10,000, is also 100. So what is the difference? Why am I using cross instead of using 100 leverage? The difference is in cross, it make use of your wallet balance. But in a 100 times leverage, it doesn't ask you about your wallet balance. In isolated, the liquidation price is always based on the leverage. So as you can see, if I'm using 10 times leverage, no matter how big or how small my size of position I'm having, the LP price will be constant. Okay, let's say I'm entering at the price of 9,600. So my LP price, if I am using 10 times leverage, the gap will be roughly at 500. So that my liquidation price is around 9,100 if I'm placing a long at 9,600. So that is $500 gap. This one is fixed. Same scenario to 100 times leverage. If I'm entering against 9,600, my liquidation price will be around 9,560. It's around $40 gap. But at Cross, there is no fix because as you can see, isolated is fixed one. The LP price is based on the leverage. But at the Cross, it doesn't based on leverage. It's based on your wallet balance. So what is a wallet balance? If you have a position on 1%, let's say $100 is your 1%. Since that 1% is 100, so 100% is 10,000. So I use $100 as my 1% to enter my positions. So means that my wallet balance got 99%. Okay, this is my wallet balance. So when my position size is going higher, my wallet balance is getting lower. So at Cross, when wallet balance goes down, liquidation price will getting nearer. Let's say this is your whole wallet lah. Black is your whole wallet. Red is your attack, which is your entering margin. Blue is your defense, let's say. Means that it's your wallet balance. Just imagine when you're giving too much resource into attack, of course your defense will drop. So when the defense resource getting lower, getting decreasing, you will be more fragile. Equals to your liquidation price is being approaching to your entering price, which means your liquidation price will getting nearer. But let's say you are getting lesser resource on attack. Your attack going down, but your defense going up. You are more tank. Tank means that you can taking more damages or taking more paper losses before you're hitting to your liquidation price. So your liquidation price is further. If I'm taking 3% of attack, how much percentage I got in my defense? Of course, 97%. This is case A, this is case B. Let's say I use 20% of my margin to attack. So how much left for my wallet balance? 80%. So if I asking you, who have the wider liquidation price gap, A or B? A, okay? So I just give you guys the why I use Cross and the benefit. The first thing I said already is everything is standard because all is about percentage, okay? And how much you lose, you just directly times 100. If you see the P&L, you're losing 300%. 300% basically just tell you is you're losing 3 times of your cost margin. What is your cost margin? Means that let's say you put in $1,000, then you lose 300%. How much you lose? Total you lose $3,000. Just that simple. Everything is standardized and you can pre-calculate even though the scenario is yet to happen. The second thing I say is flexible. Why is flexible is that you can control your liquidation price. Means that if I know that the liquidation price is too further, I want to risk more to earn more. Then I want to have a great adjustment on my liquidation price so that I just slightly increase and see that maybe 4% is enough. If let's say I increase up to 8%, oh, the margin is too high in threatening my position to hit my liquidation price, okay, then I stop. So that losing whole wallet, this case is not happening one because since I will place a cut loss there. Since that we know how to use Cross, we need to estimate our potential loss. Because since that we do everything based on risk reward. So of course we need to learn first how we calculate our risk. Let's say I give a scenario, I just want to lose nothing that is more than 5%. This 5%, how I'm gonna calculate it? How I'm gonna place my margin? How am I going to place my cut loss? Okay, so this is what I'm going to teach in these sessions. In an order, okay, let's say we just use back a support resistance. This is a resistance, this is a support. So let's say this is the price at 9,600. This is like 1138. Okay, I don't care how the price moves. Let's say it moves up, down, here, blah, blah, blah. Okay, let's say we are here. I want to place a long or short. Of course, I go long. Let's say I put my cut loss. Okay, so 9,400. Okay, we have a $200 gap to place our cut loss. So here comes the part. How much percentage that you don't want to lose over it? My cut loss is 9,400. Then I don't want to lose anything more than 5%. So what is my margin? Let's say I have 10 BTC. I want to enter at this long. How much of BTC can I enter for my margin positions? Okay, let's say you think that you can put 0.5 BTC. If you are using Cross, the change of BTC price per $100 equal to 1% of the BTC market. Roughly there. But after leverage, because since that we are using Cross, actually the percentage is 100%. Since that is 100% means that you will see the P&L of your trading account by bit, it will be seeing 100% loss. Okay, 100% loss means that there is one-time loss of your margin. What is your margin? You put it 0.5. So you lose 0.5 times 1, which means you will lose total 0.5 BTC. 0.5, 10 BTC. How much is the percentage you're losing? 5%. Okay, so another case scenario, ETH. Just so you know, ETH, the max leverage is only 50. Okay, so here comes the tricky part. So let's say I want to place a short at 380. I want to place my stop loss at 420. Let's say the change or price of Ethereum $4 equal to 1% in the market of Ethereum. So my question is, I don't want to lose anything more than, let's say, 12%. I just show you the proper steps so that you can have a view and understand how it works. So from 380 to 420 is how much is the gap? 40, okay? Every $4 equal to 1%. So how many percent if really that 380 increase to 420? Okay, of course, divided by 4 equals to 10%. So the market had appreciated 10%. But one thing that you need to take note is 50 times leverage, because it's different to the BTC. BTC is 100 times, so that you can see 1% appreciation equals to PNL 100%. But in the 50 times of Ethereum USD, you need to multiply by 50. On your PNL, how much you will see? 500%. So 500% equals to how much? Lose 5 times of your margin. Means that if I lose 500%, I will lose 5 times of my margin. But I only can lose the maximum 12%. So it's very simple. My 12%, my max loss divided to my margin loss factor, 5. 12 divided by 5 is 2.4. So 2.4%, let's say you have 5.8 BTC in your wallet. Okay, so it's very simple. 2.4% times of your wallet balance is 0.1392 BTC. This is your costing, yeah. So why I need to teach you guys this, because let's say you trade other altcoin, you can see something like 75 times 1. In Binance, the Bitcoin max leverage can come to 125. Okay, so how are you going to calculate by this method? Lor? Thank you guys, bye bye. Hello, rest time.